Thanks for your company for the weekly wrap. I'm Jessica Amir, market analyst with Bell Direct. Well, a positive news, 6 Factor push equities back to positive territory this week. Aussie shares are up 1.5% to Thursday, and the US benchmark S&P 500 up 2.5% after the US Federal Reserve announced it would buy corporate bonds on top of buying ETFs. 2, Team Trump weighed up $1 trillion infrastructure plans to boost the economy and jobs. 3, US retail sales surged 18% in May, beating 10% the market expected. And 4, and locally, the Aussie government announced $1 billion in infrastructure spending. And 5, the RBA said economic growth could be ahead of the curve, which is why it wrapped up $50 billion of bond purchases, which helped to drop the 3-year bond rate to a record low of under 0.25%. And 6, the ATO revealed payroll numbers actually rose 1% in May, despite the official unemployment rate rising more than expected. So you'd think the worst could be behind us, particularly as the Aussie government expects 850,000 people will be re-employed by next month. So with sentiment high, the tech sector surged the most this week, 5.9%. Energy followed 3% higher. Health stocks led the charge, Clinuvel and Healius up 21% each. The Shell fuel supplier Viva Energy rose 13%, while Afterpay rose 12%, taking Ramsay Health Care's place as the 22nd biggest company on the ASX. Now, moving to strategy and ideas to consider next week, one of the things to consider is the infrastructure bonanza, with the Prime Minister Scott Morrison announcing the fast tracking of 15 major projects, $1 billion of spending on projects including rail, roads, the Tassie Vic Link, and of course the expansion of BHP's Olympic Dam projects in South Australia, also including $500 million of road safety works. Secondly, consider the oil price slicking up about 9%, taking WTI up to $38.15 and Brent up to $41 US a barrel on Thursday, with demand recovering and OPEC countries sticking to their production cuts as expected. Now, despite short-term risks, Citi expects the oil price to gain $12 this year, $22 next, to $57 a barrel. And thirdly, consider adding international investments to your portfolio to diversify and access some of the fastest growing economies like China, which is just 50% urbanized. Now, adding international investments to your portfolio typically decreases volatility. Vanguard projects US equities will rise 5.5 to 5.7% per annum over the next 10 years, while global equities, excluding US, will gain 9.5 to 10.5%, both outpacing Aussie shares' expected return of 4.5 to 6.5%. Now to trading ideas. To take advantage of the infrastructure bonanza, think about the companies that will benefit, like building material giant Boral, BLD, or cement business Adelaide Brighton ABC. Now, both are backed by UBS as buys, given their strong balance sheets. And with the government expanding BHP's copper, gold, silver mine, it's important to note UBS and Goldman both back BHP as a buy. Now, NRW is already working at BHP's Olympic Dam, doing an upgrade there, and NRW, or NWH, is backed by UBS as well as a buy. And this week, it's gained 5%. You could also consider the equipment maintenance company Mader, MAD. Now, secondly, with the oil price continuing to rally, it's still vital to consider solvent, creditworthy and strong balance sheet companies. Citi's picks are Woodside Petroleum, Santos and SXY, which carries high risk though. And if you're looking for value, Goldman Sachs picks Woodside Petroleum, Oil Search and Origin Energy. UBS picks for value include Origin and Worley Parsons. And thirdly, to invest in international shares, you could buy IEM for exposure to emerging markets, accessing 800 different stocks across 12 emerging market economies. Now, IEM will get you invested into businesses like Alibaba, the Fortnite and Call of Duty parent Tencent, Samsung, and the world's leading semiconductor business, Taiwan Semiconductor. You could also buy IAA or even ASIA, which is up 18% this year. And secondly, to invest in developed global markets, you could invest in VGAD, getting you exposure to 1,500 stocks across 20 developed economies, with stocks like Apple, Microsoft, Amazon, Facebook, and Johnson & Johnson and Visa, just to name a few. Or you could look at other popular international investments like IVV, which invests in the US. And lastly, with the US Federal Reserve buying corporate bonds, the investment grade bond index has pushed up to an all-time high. So to cushion your portfolio from a fall in equity markets, you could buy the global corporate bond IHCB. It's hedged to the Aussie dollar to minimise currency fluctuations. And this year, IHCB sits up 0.6%, while the ASX 200 is down 11%. Or for access to Aussie corporate bonds, you could buy Plus, RCB, or the M Fund ACA02. On behalf of everyone here at Bell Direct, have a happy and safe weekend. I'm Jessica Amir. We'll see you next week.